My name is Karim Ghalayini, Vice President at Horizons ETFs. Let's talk about covered call ETFs. When we talk about income-generating ETFs, most Canadian investors probably think about ETFs that hold bonds or maybe dividend-paying stocks. The recent volatility in the stock and bond markets highlights the difficulty of depending on bonds and dividends to generate income for a portfolio. Increasingly, Canadian investors have been turning to covered call ETFs, which can provide income from a wide range of asset classes and sectors through the use of covered call writing. Covered calls can be a way of taking a security that might not pay a high level of income and increasing the yield generated from that security by writing, which means selling it as a call option. Historically, as volatility rises, the amount of income that can be generated by selling calls can increase. So many of these ETFs have yields that are far higher than what would normally be achieved through traditional bonds or dividend-paying stocks. Before we address how covered call ETFs can provide attractive income for investors, let's go over what a covered call is and how it works. A call option is an agreement between two parties that gives the option buyer the right, but not the obligation, to buy a security at a fixed price within a specific time. Investors who sell the call option assume the obligation of delivering the security to the buyer of the option if the call option buyer decides to exercise before expiry. With a covered call, the investor already holds shares of the security when selling the call option for shares of that security. In return, the seller receives a cash premium which functions as income. There's also the potential to lock in profit from the sale of the underlying security if the call expires in the money, or collect the premium and hold on to the securities for longer-term appreciation if the option expires out of the money. Ultimately, pricing and selling calls can be difficult and time-consuming. Investors who do this on their own will have to set their strikes and likely monitor their options positions on a daily basis to optimize their returns. With covered call ETFs, you can take the guesswork out of options writing. Covered call ETFs are generally going to hold a larger portfolio of securities, which offer diversification, have a professional portfolio management team that is managing the exposure of the option, and seek to maximize the potential of increasing income while striving to maintain exposure to the underlying asset. Many of the covered call ETFs offered by Horizons ETFs can be used as an alternative to traditional index benchmarks, where the underlying exposure of the portfolio is similar to popular index benchmarks, such as the S&P TSX 60, the S&P 500, or the NASDAQ 100. But investors can expect to generate more of their return from option premiums. If you're worried there could be downward pressure on markets or volatility ahead, it's worth considering how covered call ETFs could help protect your portfolio and offer a source of income. Typically, the performance of a covered call strategy versus a buy and hold investing strategy depends on the underlying macroeconomic conditions. Generally, we see covered call strategies outperform in bear markets, as the premium received can offset securities' unrealized losses, while higher than average spikes in volatility, especially during bear market rallies, can increase option premiums. The premiums generated by covered call ETFs are generally tax efficient because call premiums are taxed as capital gains rather than interest and dividends, all of which are taxed at a higher rate. It is important to note that we wouldn't expect covered call ETFs to outperform traditional long-only equity strategies over an extended period, but we would expect them to generate higher yield and income and lower volatility. That is to say, that covered calls are not necessarily a way to generate higher returns. They are a way to generate higher tax-efficient levels of income for investors. In range-bound markets, which trade sideways with high volatility, options premiums are usually higher, as stocks that trade range-bound are more likely to expire out of the money, which benefits covered call strategies. Investors should be made aware that in rising equity markets, they are effectively giving away upside growth potential in exchange for income. There is no free lunch in investing, and this is the big trade-off with covered call ETFs. While there are other strategies, like dividend investing, that take an income-focused approach to equities, covered calls could be a better option in rougher markets, where companies could batten down the hatches and tighten dividend payouts. For older or more conservative investors in need of income, covered calls can be used as alternatives to traditional securities to generate income. Instead of having to increase an allocation to fixed income asset classes, investors can maintain their target asset mix in stocks, but use that stock allocation to generate higher levels of income to meet their needs. Another reason to consider covered calls? Options premiums are also taxed favorably as capital gains, making this strategy tax efficient compared to interest income incurred from bond funds and competitive against rates on qualified Canadian dividends. If you're looking to take a different approach to income-oriented investing, or seeking a strategy that could offer some risk mitigation in volatile markets, it might be worth taking a look at covered call ETFs.